Hi, welcome to Chapter 5. Here it is, itemized deductions. In Chapter 4, we discussed the 4 AGI deductions, such as student loan interest and HSAs, considered above-the-line deductions. Now we're going to turn to from AGI, the below-the-line deductions. There has always been a choice between standard deduction and itemized deductions in this case. And most homeowners used the itemized deductions because of mortgage interest. It was a huge piece of their expenses. However, the extremely low interest rates over the last several years, and yes, TCJA of 2017, changed the landscape here significantly. Now you know why I asked you to read the Tax Cuts and Jobs Act of 2017. It's all through this stuff. The standard deduction, because of the TCJA, went from $6,500 to $12,000 for single filers, from $13,000 to $24,000 for married filers, and from $9,550 to $18,000 for heads of household. This major change moved most taxpayers from itemizers to taking the standard deduction, because typically what you would do is calculate your standard deduction and your itemized deductions and take the higher one, obviously to reduce your taxable income. But because the standard deductions were raised so high, it made sense for most people. Deductions are itemized on Schedule A, and let's go take a look at Schedule A real quick. So here's Schedule A, itemized deductions. There are 6 major categories, and they're covered by each of the learning objectives. Medical and dental expenses, taxes you paid, interest you paid, gifts to charity, casualty and theft losses. Casualty meaning something happened to your personal property. Maybe your house burned down. Other itemized deductions. So those are the 6. And we're going to go over them one at a time. So learning objective number 1, medical and dental expenses. These expenses can be deducted net of insurance reimbursements, or if you have it, your employer reimbursement, for the taxpayer, spouse, or dependents. Now, the key sticking point with medical and dental expenses is they have to exceed 7.5% of your AGI. It's based on expenses paid regardless of when the care was rendered. So they must be health related, not cosmetic. So plastic surgery for a nose job is not deductible, but to repair a birth defect is. Let's take a look at an example here. So for number 1, Jose, who was 35, paid $1,600 of medical expenses during 2020, $1,100 of which were reimbursed by his insurance company. So Jose's AGI in 2020 is $36,000. So Jose may deduct his unreimbursed medical expenses, meaning $1,600 minus $1,100. So he's got $500 out there to play with, assuming they exceed 7.5% of his AGI. Now, 7.5% of his $36,000 is $2,700. Since the $500 doesn't exceed the $2,700, he can't deduct the medical expenses. It's an out-of-pocket. Learning objective number 2, state and local deductions. There are 4 major categories of taxes deductible in the year when they're paid: personal property, local real estate, other state and local taxes, sales taxes and such, and foreign taxes. So those are the 4. For most taxpayers, we're talking here about the first 3. We're talking about SALT, that's what they're familiarly known as, state and local taxes. And they're affected by, again, yes, TCJA of 2017, which limited SALT deductions to $10,000, $5,000 for married filing separately. So let's take a look. Let's take a look at an example of this. Timothy paid $275 to the state DMV for the following with respect to his pickup truck: a registration fee of $50 per vehicle and a personal property tax of $225 based on the value of the truck. If Timothy drives the truck for personal use, not commercial, he may deduct the $225 personal property tax on Schedule A. The $50 registration fee is not a non-deductible personal expense. So for Californians, you need to look at that fee you pay because there are a couple of different pieces there that you need to look at. Learning objective number 3, interest deduction. The only types of, you used to be able to take off the interest from, for example, credit card payments. Not anymore, hasn't been for a while. The only types of personal interest still available as a deduction are mortgage and qualified home equity interest on a personal residence and investment interest. Now, the qualified residence interest is interest paid on an acquisition loan or a home equity loan secured by a qualified residence. The aggregate amount treated as acquisition indebtedness for any period cannot exceed $750,000, $375,000 for married individuals filing separate returns. It's the interest on this amount that is deductible. So again, this comes back to something that I pointed out in Chapter 1, that as you go through each one of these chapters and we discuss the different sections of the 1040 return, there are details that you need to pay attention to. Learning objective number 4 deals with deductions for charitable contributions. Individual taxpayers may claim an itemized deduction on Schedule A. Here's our Schedule A. And there's the gifts to charity. For contributions of either cash or property to a qualified donee organization. And sometimes we don't think about that because, remember, it doesn't have to be cash that you donated. It could be a car. It could be a home. The amount of the deduction depends on the type of donated property and is subject to AGI limitations. So we go back to that number we calculated in Chapter 4, the adjusted gross income. The government also imposes strict documentation requirements for both cash and non-cash contributions. A taxpayer receives no deduction for services rendered to a charitable organization. So if you're doing the books for your church, it's not deductible. The services do not give rise to taxable income because you're not getting paid, therefore there's no deduction. As a result of the CARES Act of 2020, and we've talked about that in Chapter 4 as well, there are now 4 limitations concerning charitable contributions by individual taxpayers. 100%, 60%, 30, and 20. Those are the 4 separate limitations. The CARES Act increased the maximum 60% of AGI for cash donations to 100% of AGI limit for 2020. This means you can get a charitable contribution deduction for those cash donations for the full amount of your adjusted gross income. A contribution in excess of the limitation is carried forward for the next 5 tax years. So you don't lose it if you don't use it. A contribution in excess of the limitation is carried forward for the next 5 tax years, subject to the overall 60% of AGI limitation in those years. So 2020 was special. Learning objective number 5, casualty loss. The key here is that, there's that pesky TCJA of 2017 again. A personal casualty is now deductible only if such a loss is attributable to a federally declared disaster area that's designated by the president. It's a very important distinction for learning objective number 5. And learning objective number 6, other itemized deductions. So here we've got a group of things that have not been covered by the first 5. As a result of TCJA of 2017, the category of miscellaneous itemized deductions subject to the 2% of AGI limitation was totally eliminated. The category of other itemized deductions is what's left. And other itemized deductions are very limited. They have built-in thresholds or other restrictions that limit the amount of deduction that's available. So some examples are, for example, gambling losses. Gambling losses are deductible only to the extent of winnings reported on the same return, and casualty and theft losses of income-producing property. So that takes care of Chapter 5. Again, I've had lots of calls recently, and I appreciate everybody asking questions. Again, if you have problems, please give me a call. I'm always available.